And the reason why it's often seen as a potential weapon of mass destruction is because you don't actually have to put up the money. Often, what you have to do is only basically, in theory, put down a deposit. We call that an initial margin. So you can put down a deposit of, let's say, £10 and leverage all the way up to, let's say, £100. In other words, you can put £10 down and buy a stock worth £100.
Hello and welcome to the Woke Finance Podcast, the podcast discussing all things finance and all things finance related. It's your boy Peter and I'm with my co-host, my bro Drax. How are you today?
Yes, yes, Peter, I'm doing very well, doing very well. I've been speaking to a few close friends of mine of potentially taking a sabbatical from the corporate life, which is just a few months off work where I get to rest, maybe do a bit of traveling, and just focus on myself for a bit. So yeah, something I'm thinking about, and it's actually quite exciting.
Love that, love that, love that, man. We all love a bit of rest, man. If you do take it, we need to get some of your lifelong lessons. I mean, you've done that a few years ago. And
Yes.
what would you say was the biggest thing you took from that sabbatical?
Yeah, so I did it back in 2018, if you would remember. That was how many years ago now? 7 years ago. Is that right? Yes, yeah, 7 years ago. And yeah, I mean, look, I think by doing it then, that's why I want to do it now. I think in that time period, you get to really spend and allocate your time, energy, and resources towards the things that you really, really care about. Now, that doesn't mean I don't enjoy it and I don't embrace my 9 to 5 job. I do, but I think that most things there is an opportunity cost. And I think the opportunity cost of dedicating my time and energy towards corporate life right now at a 9 to 5 is quite high. And so, yeah, I would want to spend some time just resting and actually focusing on passion projects. Of course, the Woke Finance podcast and the Woke Finance social enterprise being one of those things that I want to give more time and energy towards in terms of priorities. And I think every so often we talk about retirement and pensions, and we talk about how we're living longer, and there's a pension and retirement crisis looming and actually taking place already in some parts of the world, especially here in the UK. And one of the things that we can do as a community, as people, like millennials and Gen Zs, etc., is take mini retirements, right? So mini retirements are taking short breaks, could be a year, could be several years, and then going back to corporate life, and working again. That is something that people can adopt. Now, that's not what I'm doing, but I am doing some form of that, and I think that is a fantastic way of living. And I think we should be flexible in exploring some of these ways of living.
I love that. I love that. I love that. Now, on the theme of retirement or, taking breaks, so to speak, very recently, the veteran investor, otherwise known as Warren Buffett, has announced that he will retire as chief exec of Berkshire Hathaway at the end of this year. Now, before I just get your immediate reflections when you've just seen that, I do want to give a warm welcome to our listeners wherever you are in the world. We appreciate you. We see you. Thank you for just your ongoing support. And we really do mean that when we say all over the world. We do have listeners all over tuning in at different times in new cities and new parts of the world. And we just want to say we appreciate you. But Jax, back to you. Your initial reflections on Warren Buffett, maybe longer term sabbatical.
Well, first and foremost, I think we probably need a 1 minute silence just to really take in what's happening here. Warren Buffett, in most people's opinion, is the best, most successful investor of all time.
Mm,
Learning from his mentor, Benjamin Graham. We also know that his right-hand man for many, many, many years passed away not long ago,
mm.
the late Charlie Munger. It's a time to just pause and actually really assess how amazing this man is in terms of his knowledge base, his experience, his life lessons, and what he's actually been able to achieve at Berkshire Hathaway in terms of like a consistent compounding annual growth rate of like 20% and above. These things are unheard of, and to sustain it for such a long period of time. Even at times when people were saying, "Oh, Warren Buffett's strategy is over and he's out of date and he's old and he's a dinosaur," he has always come back
Mm.
show that he is the greatest of all time. Now I wish Manchester United could do something like that, but hey, that's another conversation for another day. Warren Buffett is the greatest investor of all time, and we can learn so many timeless lessons from him. And we just want to, in fact, I would just want to say thank you to
Mm.
Warren Buffett as well, because when I started my investment journey, as someone who didn't grow up in wealth, didn't grow up. I mean, the first time I heard about a stock, I was at university studying it.
Mm.
Um, it was great to have access to places like YouTube, where I was able to actually learn and watch some of his shareholder meetings, and just listening to him speak really inspired me as an investor. And I thought maybe I could be the next Warren Buffett now. Clearly, I'm not. But it was just something that was amazing.
No, man, a massive, massive shout out to Mr. Warren Buffett, who's obviously influenced millions across the world, man. And in nature of reflecting on Mr. Warren Buffett, we're just going to touch on some of his popular quotes over the years, and we'll split into different sections. It's only about a few, not too many, but one of the quotes, which we put under the section around, misunderstood quote is diversification is protection against ignorance. Now, Jax, when I hear that already, straight away, I've come into the investing world. I hear about things like diversify your portfolio. I'm thinking, yeah, I'm gonna do a bit here, I'm gonna do a bit there. And then when I see, as we've just said, the veteran, the great, the GOAT, Mr. Warren Buffett, say something like this. What is this? What is he actually trying to say here?
Yeah, yeah, yeah. So, I mean, this quote divides a lot of people, and I think it is quite misunderstood. I think when people come across this quote, Warren Buffett, the great man himself, saying, diversification is protection against ignorance. No, when we heard the word ignorance, it's not a very positive word, is
It's a
it?
trigger word. It's a
It's a,
trigger.
it's a trigger word. I'm not ignorant. How dare you say I'm ignorant, right? And so many people think he's saying that, if you're diversifying, all it's really showing is that you don't know what you're doing. You ain't got a clue what you're doing and you're ignorant, and it's quite offensive for some people. So some people literally take that as, hey, if I'm not going to diversify, I'm going to run a very concentrated portfolio because I do not want to come across as ignorant
Mm,
or as someone that doesn't know what he's doing. I think they are very misunderstood,
mm,
or they've definitely misunderstood what he's trying to say. Remember, the word ignorance, by definition, if you look at it in the dictionary, it just means a lack of information.
hmm.
And I think what he's trying to say is that the truth of the matter is we don't have all the information at hand as retail investors. The truth of the matter is we could do all the research that we want to do. We can, look at financial statements. We can do all that kind of stuff. But the truth of the matter is we don't have all the information. In fact, in finance, Peter, there is a big idea called information asymmetry, which is when we're dealing with two types of people, we call them principals and agents. Let's say I want to invest in your company, right? You want my capital, right? Of course. So you're going to sell me the best possible information that you possibly can.
Of
You're going to
course.
say we're doing well, we're doing this, and we've got these plans. But where the information asymmetry stands, and the very specific example in this is called moral hazard, is essentially I don't actually know what you're going to do. I
Mm,
don't know if the CEO is having problems at home with his missus and he's planning to step down and get divorced and it's going to ruin him and it's going to, do you know what I mean? So I might be buying this company because it's got such an amazing management team. I have no idea what the CEO is going to do next, right? So with that lack of information, we are always going to be somewhat ignorant. And so that's why we diversify. Diversification has always been a wise thing to do. Now, what he's also trying to say is don't over diversify,
mm.
right? So you do want to gather as much information and know what you are investing in, know what the company as much as you possibly can. So you know what, Buffett, he speaks in riddles, and I truly believe that's what he's trying to say. He's not saying go and just buy two stocks and that's it. What he's saying is, you are going to have a level of ignorance, but at the same time, you want to invest in the things that you understand and get as much information as you can.
why important people to get the context behind some of these. And again, a lot of the times, yes, I must admit, some of these quotes I've never actually seen Warren Buffett say. It's just one of them things which is just, I don't know, posted up somewhere and then you just take it verbatim and run with it. So yeah, that's
Yeah.
really good to go through that quote.
Yeah, absolutely. People don't really, context, right? It's like people that quote the Bible and they don't really quote the whole verse or the
Mm,
whole chapter or the context in which it was written. It's very important to understand what the person who's written the thing or said the thing is actually trying to communicate. You don't have the information at hand. Some professionals actually get to meet the CEOs. You don't.
mm.
So it's important to understand that.
Yeah, and even then, as you said, the CEOs, the
Yes.
CFO, they're gonna present the numbers and everything, how they want to do in terms of paying the best image within obviously legal and moral
Yes.
constraints and stuff like that. But yeah, no, absolutely. Mr. Warren Buffett, one of his other quotes, which is around life, so to speak, is someone is sitting in the shade today because someone planted a tree a long time ago. Now, this
Yeah.
sounds very deep, Jax.
Yeah, it does. And I think it's actually quite self-explanatory. He's saying, of course, we talk about things like generational wealth and actually not just doing something for yourself. And understanding that sometimes you may do something and you may not reap the benefits, but someone after you will reap the benefits. So, you can take this quote and apply it in different ways. You can apply it to your own family, but I don't think it's just about family. I don't think it's just about family. I also think it's talking about people just being innovative, and people taking risks and people inventing new things, and understanding that we as a community, as people, have better lives today because of some of the decisions that people made a long time ago. And I think that's
And
really, really important.
and what we do today may influence and make people's lives better in the future. And again, we make that what we do today may be small, it may be big, but that's just how life goes. Yeah, so no, really, really interesting life quote.
Yeah, absolutely. And, of course, you can always relate it to investing. We know that investing is about planting seeds. When you invest, you are literally planting capital, which can grow over time. And we know time is a huge component of compounding. So, yes, it's a life quote, but of course, you can also pick up the investment kind of lesson from it as well.
On investing, one investment quote Warren Buffett says is rule number one, never lose money. And rule two, don't forget rule one. Now, I love this, but I mean, someone hearing this would be like, well, duh, you don't want to lose money and stuff like that. But let's take a bit more of a deep dive because for him to say that, it's like, obviously, we don't want to lose money, but he's saying it because listen, this guy always follows his rule. He doesn't lose money.
And this is why I say about Warren Buffett, you've got to understand the context from which he speaks. Because, I mean, rule number one, don't lose money. Okay, like as if we're in control of whether we're going to lose money or not,
Mm,
right? And then he says rule number two. He goes on further to say, don't forget rule number one, which is
mm.
it can be quite frustrating to hear, right? If you've been losing money in the stock market. No, but again, context is really important. What Warren Buffett is trying to communicate here is when you are investing. This is very much linked to his idea of like investing with a margin of safety,
Mm,
which is a lot for value investors. When value investors are buying stocks, they do a lot of analysis, they do a lot of valuation analysis to understand how much a business should be valued at, how much a stock should be valued at. And let's say they do the analysis and they come to a valuation of a company so that the stock price should be $100 per share. Then if currently in the stock market is trading at, let's say, $120 per share, then in theory then they should buy the stock, right? No, sorry, they shouldn't buy the stock. If it's less, then they should buy the stock. So if it's, let's say, $80 per share, then they should buy the stock because the real valuation is $100 per stock. What he's saying is really and truly the margin of safety means actually it should be lower, so you should, create some sort of buffer. That's the real word I'm looking for. You should create some sort of buffer so that you give yourself some safety. And that's how you basically in his head, that's how you make sure you don't lose money. So wait for the stock price to be 70 or $60 per share, even though your analysis says it should be $100 per share. That's why it says rule number one, don't lose money. Rule number two, make sure you don't forget rule number one. And of course, this goes back to even what I was saying earlier. One of the best ways to not lose money is to diversify. So
Mm.
you've got to listen to this guy
It all
with
connects. This is not, how many decades, 999 plus or so decades of information and knowledge that this guy is just dropping gems, And yeah, as he gets old and, to his so-called final days, I'm sure he's gonna even want to be dropping one or two more gems as well. So
absolutely.
definitely stay tuned, man. A very popular quote, which we've definitely said on this podcast a couple of times, is be fearful when others are greedy, and be greedy when others are fearful.
Yeah, yeah. So he's talking about being a contrarian investor, which is the stock market's got the stock market has a lot of participants, and participant behavior, herd behavior can cause the stock market to be overvalued and undervalued sometimes. So there are times where the stock market, everybody's buying and there's bubbles and the stock prices are going higher and higher and higher. That means everybody's excited, and he's saying, well, if you see that happen, you should have a side eye. You should start getting scared.
Mm,
What he's trying to say is a bubble's probably about to burst. And vice versa. If there is something that's gone wrong and there's a crisis, recessions, etc., and everybody's selling, everyone's scared, everyone's fearful, that's probably the best time for you to buy. That's essentially what he's saying. Now, it's self-explanatory, but in terms of actually implementing this, it requires a level of thinking that's not common for the average person, to be, and he uses I mean, these words greed and fear, these are what we call our animal spirits, and these are things that often drive us to make irrational decisions, but he said use it in the opposite way. And so, yes, when the stock market's absolutely flying, he says be fearful, which most people are not. Most people are actually excited when it's going up. And he says, be greedy, which is a very interesting term. I think he's just trying to say, hey, when it's when things are on sale, you probably want to buy and buy as much as you can.
hmm. Love it, love it. And sometimes easier said than done, but yeah, so important we remember things like this. Just got a couple more. The next one is it's only when the tide goes out that you learn who's been swimming naked. This guy, he
And
knows
this
how to
guy,
trigger people.
I think he's definitely seen a lot of people fail and
Yeah,
make
yeah.
mistakes. And I actually really like this one because I've actually seen it in my own journey.
Mm-mm.
Mistakes that I've made where I was swimming naked, right? And
Mm,
now that I swim properly, right? Because I've learned my lessons, and vice versa. You hear a lot of people, particularly on social media, now who clearly, in my opinion, are probably swimming naked.
mm,
Which is essentially, look, when the stock market is going up and going up again, for example, and a lot of the time it might be going up for a very specific reason. One of those specific reasons could be, let's say, a very low interest rate environment, right? For that reason, the stock market may just be flying up, right? The tide is going higher and higher. Even growth stocks that have no profitability, no one really knows what they even do. We experienced this in the when did you experience this? In the dot-com bubble where lots of tech
mm,
companies were not, people didn't even know what they were doing and they were still investing in them, right? And the stock prices were going higher and higher. Same way in the global financial crisis, the credit crunch that was birthed out of the subprime issues, which is basically everyone's buying property. The tide was high. But
mm.
then when the tide goes down, when the tide goes down, you start to really see who was over leveraged, aka who was swimming naked, people that lose their homes, people that lose assets, etc. Those people did not invest properly. That's what he's trying to say. They did not have their risk strategies in place, they didn't diversify, they didn't know what they were buying, etc. That's what he means, but you get to see who's actually swimming naked. Guys, let's not get caught swimming naked. That's one lesson that I learned.
On the back of that, with the next quote, which is only buy something that you'll be perfectly happy to hold if the market shut down for 10 years. What if they said, listen, I was following this quote, I was buying things that I was happy to hold if the market shut down for 10 years?
Yeah, well, what he's trying to say here with the 10 years analogy is remember the stock market is just a marketplace, right? And I actually really love this quote because it's one of probably one of the quotes that have made me a much better investor, which is you need to understand that the stock market is a marketplace. And so when you go in there, you buy something, you have to buy that something for a reason. What do you actually want that thing for? And essentially, you shouldn't care too much about what the other market participants are willing to buy your thing off you for, right? So let's say you go and and this is why in previous episode I talked about my the fact that I've leaned a bit towards dividend paying stocks that return capital in the form of cash flows to the investor, because you are not depending on the market participants just buying your stock off you for a higher price. You actually buy something that gives you a growing stream of income. And that can take place. If the stock market is shut, you're still going to get your cash flows, because the cash flows is to do with the actual business. And that's what he's trying to communicate. All he's trying to communicate is when you buy a stock, you are buying a real business. You're not just buying a ticker symbol. You're not just buying a lottery ticket that changes prices every minute. You are actually buying a business. And
Mhm.
his way of communicating that is, imagine the stock market was closed. So basically you will not see valuations change every 2 minutes, for example. You just imagine that you had your stock and it done whatever it needs to do in terms of actually producing cash flow. Which is why if you look at Berkshire Hathaway's portfolio, I think almost all the assets in the portfolio return capital to the investor in the form of dividends. That's what he's trying to communicate.
Mm. Love that. I love that. Now, the final quote we got, again, I do think, obviously there's lots of learnings from Mr. Warren Buffett, and he's seen a lot. And then some of his quote can trigger different groups of people, as well, which is yeah, always interesting. But before I read this quote, this final quote, Jack, so we're gonna give a shout out to where we're getting listeners from. And this area is an area called Tukwila, which is a city in Washington State.
Is that America?
Correct.
Fantastic. Well, Americans are our second biggest listeners. Welcome to the World Finance Podcast. You will have the co-host Peter, your co-host Peter, and myself, Jax. And on this podcast, we talk about all things finance related and all things related to finance. If you want to know more about what we do, you can head over to www.walkfinance.co.uk. That's www.walkfinance.co.uk. And if you want to engage with us on social media, we are on Instagram, we are on TikTok, and we're also on LinkedIn. If you search for Walk Finance, you will be sure to find us. Welcome to the episode. Welcome to the podcast. I hope you were enjoying and gaining tons of value.
Love it, love it, love it. Massive shout out to our listeners over there and all over the world. Now, Jax, for this final quote, it reads, derivatives are financial weapons of mass destruction. Now, Jack's two things. We want to know what derivatives are or summary, but to use this phrase of financial weapons of mass destruction, that is powerful. And we need to
Yeah.
understand the context of this.
Yeah. So what are derivatives? The clue in its name is in its name, sorry. A derivative is a financial instrument. Its value is derived, hence the term derivative, is derived from an underlying asset. So essentially, it gives you synthetic exposure. So it's not a real exposure, it's a synthetic exposure to an asset. What do I mean? What do I mean is a derivative allows you to create a position in a stock without actually owning the stock. And so what you're really doing is you're just betting on the price movement of that asset. Could be stocks, could be shares, could be commodities like gold, silver, etc., oil, and so on and so forth. And the reason why it's often seen as a potential weapon of mass destruction is because you don't actually have to put up the money. Often what you have to do is only basically, in theory, put down a deposit. We call that an initial margin. So you can put down a deposit of, let's say, £10 and leverage all the way up to, let's say, £100. In other words, you can put £10 down and buy a stock worth £100, which means you've basically borrowed the 90% in theory. Follow my example here. That means if the stock does well, you do well, right? And you get leveraged returns. It'd be like property. If you buy a property, you put down a 10% deposit. If that property goes up by 100%, you still gain by that 100% plus, etc. So derivatives are attractive for a group of investors called speculators, right? Because they are able to use just a small amount of money to get exposure to big, big positions. And that could be great when things are going well. But the thing about leverage is it's your best friend when it's going well, it's your worst enemy when it's going bad. And you can end up losing more money that you've actually put down. And that's the
Mm.
scary thing about derivatives. Now, derivatives, in theory, were not supposed to be speculative instruments. Derivatives really and truly are supposed to be hedging instruments. You're supposed to use them to hedge real life situations. That's how it was first came about. Actually hedging the prices of future assets and stuff like that. However, like most things that human beings touch,
We corrupt.
people are around. So people have misused this product to actually speculate. And that is one of the reasons why when things are going bad, they go really bad. People tend to really leverage up their positions and it can cause huge bubbles in the stock market. And of course, with that comes huge collapse and crashes as well.
Deep, 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 man. No, thank you very much, and for that explanation as well. Very clear. And yeah, man, Mr. Warren Buffett, man, a man of many words, many quotes, but most importantly, so much education and knowledge that he's chosen to share with the world. So a massive shout out to Mr. Warren Buffett. But yeah, Jax, man, it was just an opportunity to reflect. I mean, he's still with us. We obviously done an episode on Charlie Munger, sadly, when he passed away. I think just over a year ago. But yeah, Mr. Warren Buffett is here with us, but he's obviously just announced he's with stepping down as CEO of Berkshire Hathaway. So we thought we'd just do a quick episode on
Yeah.
some of his quotes as well. But Jax, yeah, any final words, man?
Yeah, bro. I mean, I haven't watched all of it, and I probably won't. But normally I see snippets and I watch snippets of the Berkshire Hathaway's annual shareholder meeting. And I must say this was a weird one. Because there was no Chalamanga.
Mm,
Usually it's both of them, right? And they go back and
mm,
forth, and it was yeah, it was just very, I felt a type of way watching some of the snippets without his right hand man. So actually, I'm probably not surprised that he stepped down. He's lost his right
mm,
hand man. You know what I mean?
mm.
So it's time for him to enjoy the rest of his life. He does mention he wants to spend more time with family, etc. So I think it's a fantastic thing what he's been able to achieve as such an amazing company, a company that we can learn much of. And I think his successor will be successful as well.
Come on, come on, come on, man. A massive shout out to Mr. Warren Buffett and Jax. A shout out to you. For our listeners, a massive shout out. Remember all,
Stay
stay woke.